Hey guys, video 2 for the final exam, the practice exam, sorry. So, up to question 3. Someone purchased a patent, successful litigation in defense of the patent. So, again, realizing that successful litigation adds to the value of the patent, um, and we'll probably have to adjust our amortization and such. So, prepare a calculation of the carrying value of the patent at December 31, 2020. So, carrying value means whatever I originally paid for it, the amortization I've recorded to date, the litigation, and any amortization of that. So there is a hint here on how to do that on an exam. You probably wouldn't get that hint. I think the key thing that we're trying to test here is you understand accruals and time periods and etc. building this up. And then we're going to record amortization expense for the year ended December 31, 2020. Which 2021 would have probably been a better question, but that's what we did. So carrying value of the patent at December 31. So my cost was 60,000. And just to keep track of dates, I'm going to put July 1 of 17. It's got a 10-year life. So my amortization per year is going to be $6,000. So if I'm looking at my carrying value, what do we want to do? Want to do T account? Sure. This probably isn't the, well, it's definitely not the quickest way to do it, but so I started with 60,000. Now the July period here, right, that's intended to make sure you get the periods right. So July 1, 17, so July 1, 18, I'm going to book $6,000 of amortization. Again, could go to an accumulated amortization account, but with intangibles, a lot of time it just goes to the account. And then I'm going to do the same on 19 and the same on 20. So far, so good. And then if I'm going to December 31, I need another $3,000, right? Half a year. So the original patent value but then I spent $11,000 on successful litigation of a patent on July 1, 2020. So if we look at that, it's going to get added to the value of the patent, so it would be in the same account, but just for demonstration, I think we'll track it separate. I'm going to put 11,000 in. And one of the key points on this is, what's the life of that $11,000? And the answer is 7 years. Right? Because the patent had a 10-year life 3 years ago. It's got 7 years left. So it's and I've only got 6 months gone by, so 0.5. Okay, so again, the $11,000 was spent July 1, 2020. At that point in time, the patent has, so I can capitalize that to part of my patent. At that point in time, the patent has 7 years of life left, so this 11,000 is going to get amortized over 7 years. I'm going to take half a year, so the value sitting in the patent account related to The legal fees is the 10,714. So oops. It's equal to that plus. Of course, these would all be in the same account. I find it easier to track them separately. What's my amortization expense for the year ended December 31, 2020? Well, I'm going to have 6,000 for the patent. And I'm December 31, 2020. I've only got that half year for the legal. Okay, so I think the primary thing we're testing here, one is the knowledge of the patents and that the legal fees add to it, but the rest is really just tracking dates and being careful with dates and half years and how many years are left in the life, etc., etc. Okay? Question 4. Balance sheet, some more information, prepare a statement of financial position in good form. Okay, and calculate a couple of ratios. So we've got a balance sheet that's put together incorrectly, and we need to fix it. So again, you're going to need to draft a statement of financial position. Whether you have to fix a bad one or start from scratch out of a trial balance, both are kind of the same. So first thing, the title for a balance sheet or a statement of financial position, either title is fine. It's not for a period of time. It's not for the year ended. It's as at. Horrible spacing, but we're going to leave it like that. So let's just grab our accounts here. So first things first, balance sheets, statements of financial position always have to be classified. So I would get in the habit of, if you're asked to do one, start with this. Right, I need current assets, I need current liabilities, I need to come to a total of total current, and then I need to come to a total of total assets and total liabilities. Need some shareholders' equity. And somewhere down at the bottom here, I need to get to total liabilities and shareholders' equity. That's a little short, but okay. So cash is always a current asset. Cash is always the first current asset. What's in there? Well, it's an investment in a bond with a value of $9,400 using the amortized cost method that matures in 2021. So what year are we looking at? 2019. Well, that's long term, right? So somewhere down here under my current, I've got investment in bond for $9,400. And I'm going to need to take it out of my cash balance. So the cash balance that this person had done was $90,000. But that was wrong, right? And a bank overdraft of $1,500 has been deducted. The bank overdraft is at a different bank than Bruin's other cash accounts. So we saw that in a question in class. That's a liability. If it's at a different bank, I owe someone else money. And then just watch the signs. Do I have to add or subtract that 1,500? And the correct answer is add it. Right? Because essentially I've taken a minus 15 out of here. This would be a good way to do your whole balance sheet and be out of balance by $3,000 at the end. Okay. Investments include investments in common shares that are held for trading of $24,000, an equity method of investment of $43,300, and franchises of $9,000. So again, it doesn't have the right stuff in it. We need to figure out what to do with the right stuff. Held for trading is a current asset, and it's always listed right under cash. So investment, fair value, net income. Also have long-term investments. Okay, just to give it a different name. And I have franchises, which is also a long-term asset. So what do we got? Held for trading of 24,000. Equity method investment of 43,300. And franchises of 9,000. I assume that equals the total that they had in here. 76. Yeah. Okay. Equipment costing 8,000 with accumulated depreciation of 6,000 is no longer used and is held for sale. Fair value equals carrying value. Accumulated depreciation on the remaining equipment is 40,000. So we didn't spend a bunch of time on held for sale, but that has to be disclosed separately, and basically fair value, what you can sell it for. So in this case, it's 8,000 minus 6,000. I've got assets held for sale. And it's 2,000, right? 8,000 minus 6,000. And accumulated depreciation on the remaining equipment is 40,000. So again, all I need to disclose the accumulated depreciation, and of this 86,000, 2 of it's held for sale. So the other 84,000 is my equipment. Let's just do it here. $86, so I need 84. Okay. Accounts receivable, shareholders' equity includes common shares of 100,000 and retained earnings of 108, so I need to break that down. My accounts receivable is 57. I see I've got an allowance over here on the credits of 48. I need to net that. So it's going to equal 57,000 minus 4,800, and I need to get that in the wording. Net of $4,800 allowance. A few more words than that might be all right, but inventory is also a current asset, 57,000. And it would be next in line. The investments we dealt with, the equipment we dealt with, and we have patents of 32. Okay, so let's just stick my total current in here because I do need to total my current assets. Throw some underscores in just to make it pretty. And then these were all my long-term ones, so my total assets includes the current. My liabilities, I've got that bank overdraft. I've got accounts payable of 75. Again, don't use AP here. This is a financial statement. It's a public document per se. So we should, have some decent formatting. I'm not going to be too anal, but total current, because the only other liability I saw was long-term debt. This video is going way too long. Of course, I'm also doing like a 28 mark question in 7 minutes, so. Oops. Long-term liabilities, 110,000. It doesn't tell us anything about any of it being current, so total liabilities. I got my shareholders' equity, and they just put, when he did the original balance sheet, he just has 2085, but we do have the breakdown. We need to include that. So common shares 100,000, retained earnings 1085. Suppose we're going to balance. I'm a little worried. My shareholders' equity plus my liabilities. Oh, look at that. Life is good, everything balances. And current ratio and quick ratio, you guys have the formulas. Current is just current assets. Oh, let's do it. Just take a second. Current is equal to current assets divided by current liabilities. Again, I'd have that formula sheet. There's not going to be a ton of ratios on the exam, but boy, it sure makes it easy. And in quick, the formula is a little, the wording is never the same. When you want quick, it's all of your current liabilities, but your current assets, it's really just equal to the ones that are close to cash. So you would never include inventories. You wouldn't include prepaids, but you would always include receivables, investments, and cash. And those are typically the ones to include. I think they say, I can't remember what they say in the formula. I'm not sure what that is there. Okay, so 215, I think I got the right formula. C29 to C31 divided by G32. Okay, so again, the quick ratio, don't include inventories, don't include prepaids, don't include anything that's not going to turn into cash right away. Thanks all.